Good morning, everybody. So, for those of you that don't know me, my name is Jaszewski. I started my life in corporate world 35 years ago, and about 20 years ago I decided to break off and get into rental investment properties and things of that nature. And then 15 or 16 years ago I also got into real estate, and so that's kind of how I ended up in selling campgrounds for a living. But in the past, let's say 8 years, I've sold about $110 million of real estate. And I find that campgrounds are really a passion of mine, just because the people that tend to own them tend to be down-to-earth people like all of you in here. And I like to help people win. So this class will just be about helping you understand the value of your park as it maybe sits today, some of the things that you hide in your numbers that we can talk about, and how to improve that situation. So what's your campground worth, how to get more money from the bank, P&Ls, margins, money, exit strategy if you ever need one. So what's it worth? There are many acceptable methods of valuing your business. One method may be more suitable than another, and based on the bank you use, they may define the value they choose to use. There can be an appraisal value, there can be an operating income value, income approach. There can be a sales approach, like if another campground sold in your area with the same amenities, that might be an example. So there's two that I want to talk about today in particular though, and one of those is called a multiplier option. And with the multiplier option, some experts in this industry have talked about using a multiplier of your gross income. So in this case, many of these experts talk about 2.8% of your gross income, or 2.8 times rather your gross income, up to 3.8 times your gross income. I find that to be a very flawed formula. My approach is always to say use net operating income. That basically says, what is my place worth based on what I bring to the bottom line before my note, before my mortgage? So the multiplier option is pretty simple. It just says, I'm going to take 3 times, for this example, we'll use 3.5 times sales. So let's take a campground that's worth $100,000, has $100,000 of gross sales per year, has $20,000 of expenses, pretty limited expenses. What would the target market price be for this campground based on the 3.5 multiplier? Anybody? $350,000, exactly. So you might think, oh, that's pretty decent for my park. If you use the net operating income evaluation, that says, by definition, take the gross income minus my expenses before my mortgage and give me my net operating income. So using the same exact example of $100,000 in sales and $20,000 of expenses, I have $80,000 of net operating income. The industry standard for this size business is about 10% cap rate. So on a 10% cap rate on $80,000, what's the same park worth under mine? $800,000, right? So the point I'm trying to make here is you could have $1 million park that by a 3.5 times multiplier, someone would say it's worth 3.5 million. And yet it takes you 900,000 of income or net of expenses to make that million. So there's no way you could make it on that, right? But the same park, $1 million income per year that only has $200,000, you know, it's a huge difference. So you guys see my point. And for me, there's only one way to analyze a park, and that's net operating income. Once you determine that net operating income is your valuation approach in my spreadsheet, for those of you that were here Thursday, I talked a little bit about how to use that to buy cabins and analyze if a cabin makes sense for you. This is a holistic approach to looking at your books every year. And I would suggest strongly at the end of this course, if any of you want, I'll send you my spreadsheet, But B, I'll help you walk through it the first time, even if it's over the phone, to put your numbers into my spreadsheet. And then next year, put them in again and see, did you improve or not improve year on year, and where are you stronger and where are you weaker? Setting aside your personal feelings about your park's worth is important to establishing a realistic and competitive price. Sometimes we, as owners, become very attached to our place, and we try to put a number on the fact that we plant pretty flowers every year around all of the little nuances in our park. And I hate to tell you that people might come there because the flowers are there, but those flowers themselves are not making you any money or generating a line item on your tax return that says, I planted flowers and therefore I got 4 more people to come. So you got to kind of look at your own situation and say, where in my park can I create more revenue? And what do I have to do to make that a realization? So we need to objectively analyze the business records, assets, study the current marketplace, people around you, campgrounds around you, what are they doing? Could I be mirroring that? As you probably all already recognize, no one in here is really a competitor to the next guy to your right or to your left. You're all sharing a lot of the same people. If you're an overnighter, you might be going to Eric's Park one day and somebody else is the next day. That's just how you roll. And so you work together to try to create common elements that everyone sort of accepts as a standard, and then peak from there. Your seasonals are pretty generally, they stick by you, don't they? I mean, unless you screw up, unless you drive them away, they're usually going to stay. So that base is your base, and then your overnighters are kind of commonly shared. And then I would always say consider employing the expertise of a professional in this field. Somebody like myself, doesn't have to be me, can be a banker, can be an accountant, but somebody that understands this industry and the nuances of what's really an expense and what's really an improvement. You got to prepare your financial statements, gather information. 3 years from me, I like to see 3 years of tax returns. I like to see where you're going. If there's an anomaly, what caused it? Was it a flood? Was it bad weather, etc.? Tax return, P&L, personal items that run through the business, and non-reoccurring expenses. I'll talk a lot about non-reoccurring expenses. Using the latest tax return we start with exactly what you reported to the IRS. So I look at either your K1, your Schedule C, and any statements that support the Schedule C, take all those numbers off there directly, throw them in my spreadsheet, and we start with that as a baseline. And then we pull things out, such as depreciation, which is a non-cash item. So in other words, if you're depreciating your park, the government says you can take this 20 grand off of your income, and then I'll tax you on that number. So it's a non-cash item. Interest, we always pull that out because your interest, if you're selling a campground, for example, your interest is not relevant to the new guy's interest, and we'll put that mortgage in to our pro forma. And if you're not selling your campground, we'll stick in your existing mortgage and plug that into our pro forma. So we back that out here. Personal expenses that you run through the company. How many in here do not run any of their personal expenses through their campground? Liars. You might not, but I bet you Pete and Mike do. Yeah. But there's always something, whether it's your owner's home that may or may not be on site, the taxes for that place, or the electricity bill, or the gas bill. Something, generally speaking, gas for your own vehicle, generally speaking, is going through your business expenses. And then non-recurring expenses, such as a new roof, I paved the driveway, I had to fix a toilet, I had to put a new water heater in that's not going to repeat next year, that kind of stuff. Depreciation, I simply want to talk to you about how this is calculated, and it's basically the government allows you to take the improvements, not the land itself, but the improvements, the buildings and appurtenances on the property, and you get to depreciate them over 27 and a half years. So the personal property like lawnmowers, vehicles, cabins that are movable, you can fast track those on 5 or less years if you choose to. So depreciation is really 100% divided by 27 and a half equals 3.64% of that item's, that improvement value depreciated each year. Be aware when it comes time to sell, the government wants you to recapture that depreciation. So just a quick example, if you bought for $1 million, depreciated 800,000 of that, so you're pretty far along the 27 and a half year lane, and then you sell it for $1.2 million, you're going to be basically paying capital gains on starting down at the 200,000 level, because that's what you're depreciated down to, and the difference between that and the 1.2. So it's $1 million times your cap rate. I think that's like 15 or 20% right now. So it's something you got to be very aware of if you are in that cycle where you're selling. Make sure you're talking to your accountant. Some people actually prefer, if you're selling, to carry back a small mortgage subordinate to the bank, which allows you to defer some of that capital gain into future years. And you only want to do that if you're very confident in your new buyer. That makes sense to everybody?
What do you do if you build the campground from scratch and you don't have that purchase price?
When you build it from scratch, the accountant's going to, and the government is going to start you out at a basis rate. So once it's built, it'll be appraised, or if you're getting a loan from the bank, for example, or if you built it out of your own money, there's some sort of basis rate that your accountant will set you at year one. And then that will depreciate each year after that. Make sense?
Yeah, it's just unfortunate because sometimes banks don't understand that campground business and they get a generic appraiser that could be, it's a lot higher than what they're giving you credit for. And so in the end, it could hurt you because you're paying a lot more.
So there's 3 types of appraisals, just so we're clear. There's comparison appraisal approach, or or sales approach, cost approach, and that's the one you're talking about. What did it cost to actually build that campground? And then income approach. So those 3 are the 3 that all appraisers will generally look at when they come up with a price for you. Whether they're interested or whether they're fully aware of the campground industry or not. And so you could technically start out at a higher basis rate, and there you go to your bank and say, look, that's not where we're at. This is where we're at. This is what we paid for it. This is what it cost us to build it, and do some negotiation there, and then also with your accountant. But did you have something to say here?
Just that generally the bank hires an appraisal.
Yep.
And do all 3.
Yep, they will. Their appraisal actually shows all 3 approaches, and then they blend it together to give you a price. Does that make sense? Personal items. So if you're paying your health insurance out of the campground, gas, groceries, cars, trips, etc., utilities, when analyzing the value of the park, I like to pull these things out and just say these were personal items paid for by the campground, so that the real true money that's coming through falls to the bottom line, so you know exactly what you're worth, even if you're, again, not selling, but just want to know what your place is worth. Non-reoccurring expense, I call them SDEs, seller discretionary earnings, used in your park to improve it. And they're in your expense line for that year that they incurred. Like, say for example, you threw a $20,000 metal roof on your pavilion. Now, who thinks that metal roof is going to need to be replaced in 2 years? No one, right? So that $20,000 of expenses should be pulled out of your expenses in that year and noted saying, put a new roof on, will not occur again next year. Because we don't want your net operating income to be adversely skewed because of a one-time expense. Fair? So items that you might purchase for your company are, bought a new lawnmower, paved the park, put a metal roof on, added 10 more sites. Again, all strictly speaking one-time expenses, even if you pave the park and maybe 10 years later you're gonna have to resurface it again. We don't wanna put that in because it's only gonna occur every 10 years.
So I have another question for you.
Sure.
What happens if you are building that campground and every year you are doing something, adding sites, adding cabins, adding sites, adding cabins, adding a building, adding, that type of thing, and
It's a great question, and what I would answer, how I answer that is, it's an improvement each and every time. So each and every time, think of it this way, I'm not going to tear down that same cabin and build a new one in its place next year. So I'm taking that expense out and calling the new income versus expenses my starting point. Now, if next year I put a new cabin in again, I'm going to pull that one out again too, because those things are going to generate me income, and I'm not going to have the expense of building that same cabin again next year.
so you just have to do that for all 3 years.
Every time you're putting something in that does not repeat next year, and again, think about repeating as the same thing, the same exact cabin, the same exact road. So if that isn't going to be done next year, pull it out. Yes?
Your basis is always changing also, so if you spend $1 million, put in another 3,
Yep.
that first screen that you showed where you're only basing it off that purchase price, that's not the number you're gonna use.
No, exactly, and that's why,
Basis,
that's a great point.
example where you're buying a piece of land and building a campground, your basis isn't gonna be the piece of land. The basis
Right.
will be
The income.
$1 million you put it in.
So for example, if you put in a cabin that cost you 30 grand to build, and next year you can make $9,000 of rent off that cabin, your income is going to go up by 9,000, and your expenses are not going to have that 30,000 reflected in it. Make sense? So to your point, your basis is changing, your income's going up, and your income is, or your expenses are staying relatively flat. So let's say you decide to take $70,000 of your bottom line earnings and use it to upgrade all of your sites to 50 amp service or add 10 more sites. Now the 50 amp service is a touchy one because there you're not creating necessarily new income, but you might be creating the demand for people to come use those sites because they weren't coming because of the 30 amp service, if that makes sense. So you got to be kind of tricky with yourself in understanding how this is really a benefit to me. Because sometimes it might not be exactly obvious to the bank. So we might have to tell them, look, we're losing customers on the weekend because these big riggers come in and they got to have both air conditioners running. So they need the 50 amp service. So I got to do this to keep my business and to sustain it and to grow it.
We use that for if we want to buy a cabin. We got it because we were turning people away.
Yes, exactly.
We got it.
But to me, the cabins are so much easier to prove because you can show, okay, I got 12 cabins. They're rented every year. Every weekend they're full, plus a few times during the week. Here's what I make on them. Here's what they cost me. It's a no-brainer for you to loan me some more money to build more cabins because I'm turning people away every week. That scenario we covered it a little bit on Thursday, and I think that's a pretty easy pitch to the bank. And like I said, if anybody wasn't here Thursday, that once I have a thing, it's called a cabin analysis and a night's stay analysis. That the night stay is actually a third tab on my spreadsheet. The cabin analysis is a separate spreadsheet, so I'd be happy to send you that as well if you want. So what a difference seller discretionary earnings make to your bottom line. Once you see the impact of your pro forma by pulling out the discretionary earnings and non-reoccurring expenses, you should also account for any future impact to your gross sales that these will produce, directly to your point. So if you're going to put a cabin in, your income is going to go up by 9 grand. Your expenses are going to go up by $1,350. Generally speaking, industry standard says about 15% of your gross income on the cabin should be for cleaning and maintaining that cabin for the next visitor. At the end of this, we'll go switch to a spreadsheet and I'll show you some examples of that. Anybody know what EBITDA means?
Tax depreciation.
Earnings before interest, taxes, depreciation, somebody said it there. Amortization and appreciation. So that's basically when you're paying down your principal, you're making your park worth more, right? So EBITDA explained is just one measure of a company's operating efficiency. It basically measures the profit without having to consider other factors such as financing costs, your mortgage, your interest, accounting practices, the depreciation, amortization, appreciation, and tax tables. So can anybody see what those big 3 letters stand for? EBITDA gets the fat out, right? So getting more money from the bank. Remember how important you are to the bank. I said this a little bit on Thursday. I want to reiterate it today. Banks are just like any other business. They're beholden to their shareholders. So if you have a park that's valued at $1 million and you owe $400,000 on that park, this is a great debt to equity ratio for the bank. They need you. In fact, they even loan other people money based on your equity. So all of their holdings are put into one big pot, and they say as long as I'm under 80% loan to value of this pot, I can keep giving out new loans. Okay? So they will actually loan me money based on the value of your park in my loan structure. So when it comes time to refinance your loan, I just want you to be aware that they need your loan typically, especially if you're in a situation where your debt is far lower than the value of your campground. They want you to stay. So I was talking to Terry yesterday, and he said with the interest rates changing, he just financed 2 months ago, is that right? 2 months ago, and he's refinancing again. He's got a great situation where his debt to equity ratios, him and Suzanne, have a great situation where their campground is in good financial order, so they're going to use that and leverage it for a little better rate. And that's the right thing to do, guys. It's the right thing to do.
So they're not locked in the rate then?
They are locked. Their rate is locked.
5 years or?
Yeah, the thing about rate locks, and think about it this way, 3 is horrible. A lot of people there's probably some people in the room that have a 3-year fixed rate. And sometimes, if that's the only way you can get the loan to get started, do it. Get it going. But 5 is the lowest I would suggest you try to get to. 7's even better. Occasionally you can get a 10. Locked for 10 years, amortized over 20 years. But in the situation where you're in the driver's seat, fight for 10. Because in 10 years, guess what else is going to happen? Your principal's going way down again, and they're going to need you 10 years, even more than they need you now. So you're in the driver's seat. That's all I want to say there. Again, just reiterating, $1 million, $400,000 owned is a $600,000 value to the bank. 75% of that is $450,000 of borrowing power that the bank has for someone else. So if you go away, so does that borrowing power. Houston, we have a problem. What if our gross sales don't equal what we want as a sales price if we're trying to sell or we're trying to refinance or whatever? And these are those target prices that I hate using anyway. NOI is a lot better approach. You heard me say it before, and I said it again. Gross multipliers always look back at historical sales and say, this is what that campground 4 years ago sold for. It was a 3.2 times gross. That's what it sold for. NOI looks at your books today and says what you're worth today. And that's the way I like to look at it. What if you're still not where you want? This is some of the things we talked about. Increasing gross sales, using your earnings to target items that can increase your sales. Hottest new revenue producers lately? Cabins probably, right? Park models, rentals. You know, a lot of times people will sell you their park model and you start renting it out. How many people do that? What else can we use discretionary earnings on that will be non-recurring expenses with ultra-recurring income? Golf carts, attraction slides, mini golf, kid land items, larger pull-through sites with full hookup, 50 amps of water, sewer, full hookup. Say you want to add a cabin. A fully added cabin is about 30 grand. Used model parks, maybe less. So if you can rent the cabin for $150 a night, Thursday we used 180. I pared this down a little bit. We all agreed that there's at least 50 weekend days in our season. And we all agreed that there's always somebody that's staying some days during the week. I only added 10 more days in the whole season for 60 nights. So $150 average per night at 60 nights a season is $9,000 in revenue. Minus out 15% maintenance and cleaning costs of $1,350. You have a gross revenue on that cabin of $7,650. So to pare it out, take the $9,000 minus the expenses to clean it, minus the mortgage, and I'm putting that on a 10-year amortization paid off with 0% down in 10 years. Gives you a $3,910 income per year on that cabin after the mortgage is paid and after the expenses are paid. And what does that do to the value of your campground? Adds $39,100 to the value of your campground in year one that you paid 30 grand for over 10 years. And guess what? You didn't pay for it. Somebody else did, right? So, in my opinion, I spoke a little bit about this on Thursday. There's only two kinds of debt. Good debt and bad debt. Good debt is it goes up in value and somebody else is paying for it. Bad debt, it goes down in value and you're paying for it. So jump in a brand new car, drive it off the lot, it's worth $5,000 less, right? Buy a campground, do a little work to it, it's worth $5,000 more in almost no time. So that's the point. I personally, I am very good about, I don't buy bad debt unless my good debt can pay for it. So I get a new truck when my good debt says I can get a new truck. Make sense? So if you could add 2 cabins, if you can go to the bank and get 1 cabin, I would suggest you go to the bank and talk about 3 cabins. And you can go to the shows. Most of you are going to the shows anyway. So talk to your bank and say, look, here's the thing. Money's cheap on a 10-year RAM right now, even if it's 0 down. Talk about it as a line of credit with your campground in the mix. Get 0 down, get 100 grand as a line of credit. Get 3 cabins, put them in place, do your marketing, get them rented out right away, and you're going to be cash flowing like a dream, paying that mortgage off, that $100,000 extra mortgage off with no problem. And in 10 years, what happens? We get to pull that $3,740 out of there, and that same $9,000 cabin, or $30,000 cabin that we get $9,000 of income on, is now adding about $78,000 of value to our campground instead of the 39, because we don't have a mortgage on it anymore. That makes sense to everybody? So don't be afraid to talk to your bank about line of credit. That's how I would put it down, as a line of credit on a 10-year amortization, and just try to get enough to at least get 3. Even if you choose not to get 3 right away, as a line of credit, you're only paying interest on what you borrowed against it. But it's still sitting there. So if you're doing good, the start of the season seems hot and there's still people clamoring for more cabins, maybe you go get another one in the mid-season. So think about it. When you want to sell, I always suggest that you think about a 3-year strategy for selling. So if you're a campground that has 100% of your income on the books and no fuzzy expenses on the books, you'll be the first one I've ever met. So all I suggest to you is, if there's cash that doesn't quite get to the books, in year 1, put about 30% of that on. In year 2, put the other next 30% on. And in year 3, put most of it on. That way your books will look going in the right direction each year, and they'll be more reflective of the price you're looking to get out of it. Again, the more income that you showed Uncle Sam, the more I can prove you're worth that. Make sense? Gather any financial tools that you have for that journey: true income and expenses, operating income, personal expenses, accounted for and explained. So each year, even if you put it on your campground expenses, make yourself a little notepad that says, you know, Eric took $300 to go gambling. It's got to be Eric. You know it's Eric. Eric filled his gas tank up 57 times. You know, whatever it is, make a little list for yourself so that when we sit down, we can talk through it and explain it. And again, this isn't just for selling. Come to me, any of you, come to me at any time if you want help with getting some money from the bank or expanding the park or, you know, putting in 50 more sites or whatever it might be. I'm here to help you build a strategy for your bank to do that. Any questions here? That's me. If anybody needs anything, you can email me. I'm going to show you our spreadsheet with just some examples of what happens. So can everybody see that okay? Here's a campground, and what I'm doing is a 75% loan to value. So we're saying our campground is $1 million purchase price, and I have a $750,000 loan on it, which means I put $25,000 down. This spreadsheet is exactly what you'll do is you'll key in your nightly income, nightly seasonal store, cabins, rentals, and you can change these headings to whatever is relevant for you. And then as you get over to the end here, this says, and so if you look at this $15,000, it's really $180,000 divided by 12. So you put your yearly expenses or your yearly incomes in, and then I divide them by 12. And the reason I divide them by 12 is because even though most of your income is coming in the summer, as we all know, you do have expenses all year round: mortgage, gas, lights, etc. So I try to show you, here's what an annual expense is going to look like, and you're going to have to kind of figure out when I need more and when I need less. But once you plug that in, and then here you plug it in your loan, and I just put today it's probably a little high rate of 5.5% over 20 years, most likely on a 7-year fixed rate, giving you enough time to pay down your note. And then each of those buckets shows where I'm getting my income from. Down here is the taxes on my property, the insurance on my property, busted into a monthly figure. What my utilities are, $52,000 divided by 12. Advertising expenses, $15,000 divided by 12. Supplies, and these are all buckets you can fill in here, okay? And then credit card expenses, payroll expenses, et cetera, et cetera. So in total, I'm spending $19,894 of my 29. Make sense? What that does is my 29's here, expenses here, and then I extrapolate it back to yearly for you. So that says I'm bringing in $348,500 in income. I have to expense $238,000 of that to get it, leaving me a net operating income of $109,000. So this $109,000, starting with a basis cap rate, an assumed cap rate of 10, is how I come up with the valuation. So this 109 times 10 is where you get your valuation from. So once you plug in your expenses and income, it'll drop down, show you what you're making cash flow wise after you make your mortgage payment, which is right here. So the 5159 right here is your monthly mortgage. Extrapolated over a year is paying $62,000 of mortgage on this property. What the bank is very, very concerned with, and as you go forward, always look at this number, your total debt service to percentage coverage. And what that means is, after you pay your bills, the operating income that you have left, how much money do I have left over to pay my mortgage? The bank wants to see that at no less than $1.25 left over for every dollar of mortgage. So this percentage right here looks really good, right? So that's telling you have $1.77 of cash left over after I paid the bills to pay every dollar of mortgage. Make sense? So it's a quick and easy way to kind of police yourself to say, how am I doing on my cash flow, and do I have enough to pay this mortgage? Okay, so that's this to that. I have $1.77 left over to pay that. Make sense? So then, what this also does is it shows you this is how much I could put in my pocket each year. These are what? Can anybody tell me? SDEs, right? This is your seller discretionary earnings. So these are your earnings that you can use to grow your park, put back in your park, pay yourself, or a combination of all those, okay? And then I also, for your own benefit, I calculate what the actual cap rate is. So if we're saying you're worth $1 million, and again, this is a target for you to change every year. So if year one, you're worth $1 million, year two, you end up worth 1.2 million, year three, you're 1.4, whatever, you can always change this number and see how it lands down here. And if you don't land on a 10% or better cap rate, then your number up here is wrong. Then you're not worth as much as you thought. You change it to be according to, what you're trying to do is at least get this number right here, property value based on NOI, to be at least 100%. See here we're below 100%, that's great. Should be below 100%. So if you see that, you'll remember why that's what it is. But in this case, we're actually producing at 11% cap rate. So does anybody know what capitalization rate means? Simply stated, it says, if I paid $1 million for this campground today, I should be able to realize my initial investment in 10 years. 10% per year I get back out of the profits, the net operating income, not, that's before you pay your mortgage, the net operating income of that campground each and every year for 10 years, and I'll have gotten my $1 million back. This is saying that I'll get it back in less than 10 years because I'm getting 11% per year. Make sense? So that's a good thing. And then we talked about EBITDA, and EBITDA says it's calculating about the same rate. Now, the next sheet here, so there's a loan calculator, here's your investment worksheet. I try to take what we invested, what we paid for it, what our loan amount is. If you're going to do this, you have to plug in this number, and that's it. Everything else calculates from the front page. This land value is important to understand. The land value should be relatively low. Even if you think your land is, oh my God, my property is on a lake, it's on a river, nobody can live here, it's worth $2 million, okay? The problem with that analysis is you can't depreciate that. Land is one thing that you cannot depreciate in the United States. It's intended to go up in value per our Constitution. So I put a lower value on that land, as low as possible. And then I also put personal property in there relatively low, only because in 5 years it's gone. You can depreciate it in 1 year if you choose to, but that's why you see 20% here. This 75% is depreciated over 5 years, or 15,000 of that 75,000 each year for the first 5 years.
So what do banks mean when they're saying like the highest and best use value for land?
Yeah, that is when they're appraising it, okay?
Right.
But that is not how you have to depreciate it. When you go to sell, or if you're buying, generally speaking, both parties want the land value, you want it to be low, the seller wants it to be high, okay? Because that part doesn't get depreciated.
Right.
The personal property, you both kind of want it to be low.
So how does the bank view that then?
The bank agrees with your mutual assessment
Gotcha.
99% of the time.
So why do they use the highest and best use? What's that for then?
Most of the time, they use it to get you appraised,
Okay.
so that they can make the deal work. That makes sense? If the guy next door is selling his land at $6,000 an acre because it's hunting land, they might consider yours $6,000 an acre. Well, $6,000 an acre to you is horrible,
Right.
okay? Because that's not the best use for your land. Your land is $3,000 for a 50 by 60. Every 50 by 60 of that acre is worth $3,000 to you as a seasonal site. See what I mean?
Yeah.
So that's why they're saying the highest and best use for that acre with you is far greater than $4,000 or $5,000 an acre for the guy next door with the farm. That makes sense?
Yeah.
Okay, anybody else?
So if you're selling that land and everything now, if you're listing that, are you making them the buyer pay for your picnic tables, your other equipment, or is that?
Yeah, and that's really this personal property stuff here. You basically make a list that says, I got 2 lawnmowers, I got a side-by-side, I got a bulldozer, I got, a weed whacker, and I've got,
Pay for all that?
silverware and pans, pots, everything. You might literally list, I have 517 forks, or you might say all silverware. But both parties are gonna mutually agree, that this is what I'm selling you. This is what I'm giving you as part of the deal.
Like when you're listing it, are you showing me this is just the place and then this is everything else?
When I'm listing it, I show them an addendum that says, here's the personal property that is included with the property.
So it's included, you're not paying
Yep. No,
additional charges?
You don't. Now you can, when you break it out, you can say, of this $1 million, I'm actually paying $75,000 for their personal property. And again, personal property like cabins, might be a little higher than that. But for me, I would rather depreciate my cabin over 27 and a half years, even though it's personal property. I would rather add it down here in the buildings and improvements. Because you see, you get $24,570 off the top of your income for 27 and a half years. So if you put it up here, yep, you're getting $15,000 for first 5 years. After the first 5 years, you either got to find more personal property that you purchased that you're going to depreciate, or that 15 goes away.
Also, I talked to your accountant, there's a big difference in what you buy. If you buy assets of business versus buying corporations, and that's a concern. Depreciation basis is completely
Yes, yep, for sure. So anyway, so you guys can tweak these 2 numbers here and see what happens to your bottom line. Generally speaking, of these 3, this one you want to be the biggest, okay? That's why I calculate this. I have you plug this one in, and this one picks up the difference, okay? And so the first year, you're gonna see, I'm gonna be able to take off the top of my income, everything that fell to the bottom line, $39,570 for the first 5 years, okay? After that, it's gonna be that unless you replace more of this. So then all these expenses pop in from down here, and I know it's hard to tell these colors here. These are all different colors, and the reason I color coded them for you is because I calculate EBITDA on the bottom of this, and I want you to see in the spreadsheet exactly where that number came from up above, so you can follow along how EBITDA is calculated. Does that make sense? So, swinging back down here, we get our gross operating income, boom, boom, boom. This is our annual debt service. So this is our cash flow before taxes. We back out our interest, add in our principal that we've paid down, because that now becomes an asset. Every time I make a mortgage payment, I pay some principal and some interest, right? Every time I pay that principal, that falls into my asset bucket. I'm worth a little more now because I don't owe as much on it. Make sense?
And that falls into a bank. That
Pardon?
changes for the bank then too?
Oh yeah.
that goes-
The bank understands that every time you pay down your principal,
They get-
you're actually increasing your value. You're increasing.
How does that help them?
How-
For them to be able to lend out money, does that make it better for them?
Well,
More
not
equity you have?
not necessarily day to day, but yes, in essence it does, because every time you pay down your mortgage, even if your assets stay the same at $1 million, you owe less on it. So the gap between there is what they can borrow against.
So then if you're refinancing, how does that really help the bank?
If you're taking more money from them, if you're reducing your principal, then they're unable to loan as much to somebody else, but it still might be a nice enough bucket, even if you're adding another 50 or 60, or if you just refinance and get a lower rate.
Or if they
That doesn't hurt.
reevaluate and
Yeah.
they see it as high.
Yeah, and again, as was pointed out earlier, this number on top keeps growing.
So that's why they always want to do a new appraisal each time,
Absolutely.
so they get more value out of it.
Yep, absolutely. So I put in here a 15% tax bracket. You need to talk to your accountant on your taxes. Most of you probably have 2 LLCs. If you're doing a ROBS program or something like that, maybe not, but if you have a campground and a land LLC, so in other words, to make it simple, here is your cash flow right here. So if you add this, let's say you have a job, or you or your husband has a job, and you you make $100,000 a year. One of you does off property, and you have the other one of you runs a campground and makes $47,800. That money gets moved to your personal tax return, and you are taxed on that money at your tax bracket rate. So if you fall in a 32% tax bracket rate, you're paying 32% on this number. If you are a landlord and you own the campground in Land LLC and you rent the campground to Campground LLC, then you become an active landlord and you have a capped income of 15% on all that income. So your tax rate goes down from, so here's a good example. If you take this to 32, oops, what did I do here?
Why do you have a capped in, why does it become 15% capped?
Because active landlords are allowed to make income on properties that they physically actively manage at a capped rate, a flat rate of 15%. So for me, for example, all of my rental properties that I own, I pay income tax at 15% on all the income I make there.
Right.
I also manage on properties that I don't own. This past year, I brought in $3.2 million of rent on properties that I don't own. I just manage for somebody else.
Took in addition.
I pay, yeah, I charge them 10% of their rents for me to manage them, okay? So if I'm managing one of your properties, the income that I pass back to you after I take my 10% out of it gets put on your tax return, and you cannot claim that as active landlord income because you're not managing, I am. So that then goes on your tax return in the 32% tax bracket, and you pay another 32% off of that to the government, or whatever your bracket is. So the point is, if you look at this, what your tax bracket is, how much of this you're going to pay taxes on is $47,000. If you're in your tax bracket, it's $9,400, and if you're at an active pass rate, it's less than half that.
So if you were not a landlord elsewhere, if you're doing that 10% with someone else, you would have to pay a normal.
I'm saying that if you are your own manager, your own active manager,
Yeah.
all that income gets taxed at 15%. So my point to you is, whatever you're making here in the campground, turn that into an expense and call it rents. So all of your income flops over to rent and gets paid to the Land LLC, and then that Land LLC pays 15% tax on it. You already do that. I'm sure some of you do anyway. But if you don't understand it, come see me and I'll walk you through it exactly. But so then, what I'm trying to show you here is what is your return on your investment with appreciation, and I very simply only add 3% per year in appreciation. So right here's your initials came up, your initial value of $1 million went up 30,000 in year one, and then it just keeps plopping in every year after year, and each year you're 3% on the new number, 3% on the new number, and I think that's a pretty conservative estimate. So then I also show you what your return on your investment is without appreciation. And then the last tab you're going to see here is the build versus bulk. If any of you were here Thursday, we talked a little bit about this, but this basically says, if I choose to say my season starts from May 1st to May 30th, I have 153 days of a season. You can change that to be whatever you want. In this scenario, that gives me, those 153 days gives me exactly 44 weekend days. in that season and 109 weekday days. So in this scenario, again, you can change the sites to whatever you actually have. You can change your weekday rate to whatever it actually is, change your weekend rate to whatever it actually is, and the site nights are these two numbers together, the 153. And if we're occupied 20% on the weekday, that says that site generates, based on this rate, generates me for a season $763 during the week. And if it's occupied 100% of those 44 days up here, it gives me a weekend occupancy rate of that. So those two numbers together equals that number. The reason I do this for you is so you can see if site number 1 is a seasonal site that I pay $22.50 on, and site number 2 sitting right next to it is an overnight site that I generate $2,523 on, I've lost out on $273 on that one site. And you should know that. You should know every single site, how much it generates for you. And should it be something else? As you're new in this industry, you look and say, okay, boy, I need that seasonal money in October, December, and March to live on. The farther into this cycle you get, the less you need that pimp of money in the wintertime. So you might turn more sites into weekend sites. The other thing that people actually do in Wisconsin right now, if you are a destination campground, in other words, whatever you're after, it can only be gotten in your campground. If it's the best fishing or that lake, or people love that bar in your campground. People actually say, hey, guess what, Tommy? I know your seasonal rate was $22.50 last year, but the guy next to you generated me $25.23. So unfortunately, that's your new seasonal rate next year. It's based on what I can make that on that chunk of land. And you should not apologize for trying to make as much as you possibly can on every chunk of land in your campground. And I think if you have this discussion with people, they'll get it. And there's nothing wrong with even saying, okay, how about we split the difference and I'll go 24 this year. You guys can decide that. But if you show your campground seasonal, here's what happened.
Oh, we have seasonals who are like, oh, we'd like to be on the water. Well, you would not want to pay what a waterfront
Right.
site costs. You'd be paying 3 times.
Right, and that's the point. And if they want to pay it, good. So be it. But don't be afraid to look at each and every square inch of your property. And like I said on Thursday, I can't tell you how many times I've driven into a gorgeous, gorgeous park, and the first thing that I see is the dumpster. And I'm thinking, what the hell is that dumpster doing there? That's a perfect spot for a cabin. And do that to yourself. Walk around your campground and say, why is this here? And if you say it's because it's always been here, it's the wrong answer. Think about it again and say, should it be here? Does it have to be here? Any questions on any of this? And I do have,
Well, what happens if the site, you got prime sites and then your lowest site? Do you want to add all them together and then divide it by your site?
I would, and honestly, you can manage this however you like. You can say, literally, you could do this for every single site. You could just plug in the rates right below it. You can just copy and paste this in here and say site 1, site 2, site 3, site 4, site 5, and just analyze it completely. And what you'll find out is site 17 and 18 suck for weekend sites. So what am I going to do? Put a cabin on it. Absolutely. Find ways to create awesome revenue streams for places that you don't have revenue streams. And the point I would try to make to you guys is if you're only occupied 20% of your weekday, maybe this rate is too high. Or maybe you got to say, I'll give you, and figure out the math, but if you can get a 20% increase on that one single site by giving away something over the course of a year, do it. Figure out what that number is to entice somebody to stay one more day. Because everybody here knows what ancillary income is, right? It's the money they spend in your campground while they're there. And if they're spending more money in your campground, you want them there one more day, right? if you can get them there one more day. So don't be afraid to think of creative ways to redo these two numbers to make it a net gain somehow. As long as it's a net gain, it's good for you. Because guess what? 80% of the time, you're making zero on this site. How sucky is that? You know? So think about it in those terms and see if there's ways you can say, hey, I'll give you a package deal. We're running a special right now. It could be running a special all summer long for all they know. But we're running a special right now. If you stay 4 days, you get the sites for this much. And it sounds like a deal to them, and you're making 20% more. Fair? Questions? Comments? There's my cell phone number. Text, call anytime. I'm pretty good about answering my phone. I usually take about 200 to 250 texts a day, 50 to 75 calls a day, and about 400 emails a day. I'm not kidding. And I try to answer them all. I rarely sleep. I sleep about 2 to 4 hours a night since I was 10 years old. I get up. Do not be surprised if you see an email from me at 3 o'clock. If you email me, you might get an email response at 3 in the morning. So I'm here to help if you need me.